So before I set up any alerts or look at the charts, I always know what's moving the markets. So I read the news. For example, right now it's all about interest rates and inflation. So I keep a very close eye on bond yields because they are really important. For example, if yields are rising, that's typically not good news for assets that pay less interest or no interest in the case of gold. I keep a very close eye on gold and look for shorting opportunities. As you can see, I have two different monitors here. I keep a very close eye on the main market, so the likes of the DAX in terms of indices, euro dollar, dollar yen. I have these small charts, like they're usually like hourly charts, just to see visually what's moving and what's not moving. So I have those in both screens, as you can see. First thing I do in the morning is I look at these markets and see if anything has moved. And if something has moved, then I look deeper into it. Why is it moved? Has there been some news that I've missed, etc. I look at the charts first and then read the news after. So I have a couple of moving averages on my chart. Typically, I don't even look at them. They're just there to kind of guide me in terms of showing me the trend direction in a non-subjective way. I have the 200-day moving average that shows the long-term trend, and then I have the shorter-term 21-day exponential moving average, which is more of a short-term trend indicator. But beyond that, I don't really use much more indicators. I use key levels like support and resistance to guide my trading decision and my analysis as well. So, for example, if a major high breaks, does the market hold above it? And if it does, then I would expect to see continuation to the upside. Whereas if a key support breaks, does the market want to stay below or go back above? And then that guides my decision in terms of what to do on that day. So you always have to have an invalidation level, a level where if the market got there, your idea is no longer valid. It's essential to have that as a trader because otherwise you run the risk of blowing your account. For me, it's always at levels where it no longer makes sense for me to be in that trade. For example, if we look at this chart here, the S&P 500 has been trending lower. This green line was the previous major high. Since that high was made, we've created a new low, and now the market's bouncing back. So as long as we remain below that green line, if I'm looking for short setups, I don't want the S&P to cross that level, because if it were to cross that level, then it would create a higher high, in which case my thesis of the market going down would become invalid, right? So that's the way I look at it. The best thing I can advise is don't jump into trades. The markets will always be there. Just because you think you're going to miss out on a move, it's not really worth it to jump in a trade and not take into account the appropriate risk management or position management into account. You will find lots of opportunities in the markets. Patience is very important. Prepare, find levels where you want to get on board in a trade, and stick to the plan. That's my advice.